by sharing an experience, you're actually valuing more of the underlying reason why we give gifts. And that is to really value the relationship that we have with the person that we want to give a gift to. And maybe even more so sometimes, create a memory.
A new holiday shopping survey from the Harris Poll conducted for the American Institute of CPAs offers an early look at how Americans are preparing for the season. The findings suggest that many people who plan to spend on gifts and travel are already bracing for cutbacks, higher debt, and the emotional strain that comes with overspending. Today, we're going to break down what the numbers say and how retirees, most of all, can avoid debt. My guest, Dan Snyder, Director of AICPA Personal Financial Planning, and Cary Sinnett, Senior Manager, AICPA Personal Financial Planning. Cary, Dan, welcome.
Good to be here.
Thanks for having us on the show, Bob.
It's a pleasure. So I want to talk about what's called the financial holiday tightrope. So according to the survey, nearly half of holiday shoppers expect to go into debt this year. And for retirees living on a fixed income, what's the single most important step they should take before the holiday season begins?
Bob, it's such a great question. And I'd like to just let that statistic resonate for a moment. Half of the people are going into debt for Christmas time. And if there's a reason, a kind reason to go into debt, being generous is great. But probably the single most important step, if you don't want to be laden with debt, is to consider the idea of a holiday spending number before the season even starts. Now, we're into it, but let's plan for next year. The Harris poll shows nearly half of those shoppers go into debt, and we'll probably talk about some numbers later, how long that debt lasts. But Bob, here's a question that I'd kind of like to turn back. What if we did advanced planning? Probably pretty essential, especially for retirees on a fixed income, where for next year, you start setting aside just a little bit. And a good rule of thumb is if you are able to limit your holiday spending to, a particular percentage of your annual income. And there might be two different categories. The category of retirees who, okay, we have enough, we can enjoy Christmas time, spend on the holidays the way we see fit, and this portion, the second set, that is going into debt in order to build these wonderful experiences. So let's really offer some practical steps for them, because the crushing nature of debt while you have normal everyday expenses going up can be pretty tough. So
Yeah.
by
I'm
creating,
reminded of
Go ahead.
people used to have Christmas club accounts, right? Where they would set aside
Right?
money on a weekly, monthly basis to pay for gifts later in the year.
Yeah, that was one of my first savings accounts, is going into the bank and putting a few dollars into my Christmas club account. And if we take that concept of, okay, I'm going to set aside a little bit each week or each month or each paycheck as it comes in for holidays. And let's include birthdays, let's include maybe even vacations if you don't want it to be that one specific category. But thinking about, how am I going to spend this amount of money, and then how am I going to save for it? So if that seems overwhelming, to start the process of going, I'm going to set aside $25 or $50 per paycheck for future expenses on holidays, then we can really roll back time and use the envelope system. Do you remember that, Bob? Take a little
I
bit of
do.
cash, put it in an envelope, and put it where you're going to put Christmas presents. So if that's at the top of the closet, remember it's there, or it's in a shoebox somewhere, do that, because that is a way to go, I have spent this money already. So whether it's in that Christmas club account, a separate savings account, or just in an envelope, by thinking I am spending in advance of the holiday time this amount of money, it helps you stick to that budget so that you don't go into debt. And let's call that for Christmas 26 and maybe holiday season 27.
When you mentioned a percentage of income, is there like a range, like 5% as a good starting point, or does it vary depending on someone's income and discretionary income?
Listen, Bob, if you're going into debt for holiday spending, probably the best rule of thumb is 1 or 2% of the annual income. And that doesn't sound like a lot, but there are good alternatives to how we can stretch those dollars out that we'll unwrap together during this conversation. Dan, what do you think of that?
Well, I just think, two things come to my mind. One is everybody says, well, wait a minute, I don't want to put money in cash because what about the interest I can earn and everything? But the reality is the amount of interest you're going to earn on that amount of cash over a 1 year period or 6 months or whatever you start is really a very small price to pay for the ability to go into the holiday season with a comfort level of knowing that I'm not going to, get out of debt. The other side, and we might hit this later, but the other side is thing that I was thinking about is there are a lot of ways that I think families talking together can really start to think about the values that they have that are really important that maybe don't involve spending excessive amounts of money, whether it's going out to eat or different things. How can we spend time together as a family, identifying those values, having those quality conversations? And frankly, if I'm thinking back to my own uh, parents and grandparents, those are the things that I remember much more than like the big chemistry set that grandma got me or something. So, it's those types of things that I think have a long range impact that I think is really important.
Yeah, Cary, you mentioned gifts and experiences, and I'm reminded of a professor friend of mine who said, rather than give them the next new video game or whatever, I'm going to take my grandchildren to Yosemite, and that way I can enjoy this experience with them, and they'll remember it for a lifetime. As you sort of said, Dan, that you remember that more than the chemistry set.
Yeah.
So, I mean, is that given that's the case, I mean, would you prioritize the experience over, the next new video game or the next new whatever, sled or tricycle?
Well, Bob, that's such a great question. And I think you really have to unwrap the reason, that's a pun intended, unwrap the reason that we give gifts in the first place. So, what is meaningful when we receive or give a gift? It is the value of that other person. So, I'm appreciating you, I'm thinking of you, I'm connected to you, and I'm in a relationship with you. Now, none of those things that we just talked about said, let me give you a piece of my checkbook or here are some dollars. Gifts, money is a convenient way of expressing that appreciation, that relationship, and that connection. And Bob, just as you alluded to, by sharing an experience, you're actually valuing more of the underlying reason why we give gifts. And that is to really value the relationship that we have with the person that we want to give a gift to. And maybe even more so sometimes create a memory. And so I think if I'm thinking deeper about this, retirees, they can really be a model for meaningful holidays by focusing on that connection rather than price tags, even if it's a gift or an experience. And that's where the Harris poll really showed some interesting divide between younger Americans and older Americans. And if I read this right, younger people are more likely to overspend. And so, what a benefit our retirees can share with the younger generation about creating a meaningful experience. Dan just talked about, that he had a meaningful experience and traveling somewhere. Or for me, I did not come from a wealthy family. And so one of the experiences that I really enjoyed was going and looking at other people's Christmas lights because we couldn't even afford the lights on the house and doing that with some hot chocolate and just talking about how we like each other and how beautiful the lights are. Now, it took me a while. If I'm a young person, then I'm not going to immediately connect. Well, why didn't I get an Xbox? to here's this meaningful time together. But as we get older, and Dan alluded to this, those become the most meaningful events. Dan, wouldn't you say that those kind of connection events
Well,
that frankly
they
don't
do.
cost a whole lot?
Well, they do, but, I mean, I was a kid too, and I like getting stuff. So, I mean, the other thing that I
Absolutely.
might see I mean, I might suggest is that if you are on a fixed income and that's a concern for you, is that, talk with your kids and, for your grandkids and everything, and prioritize, the people that you're actually giving to. In our family, we decided to give gifts to the next generation down instead of the immediate generation as a way
Oh,
to let those dollars go further, and maybe your dollars combine with your kids' dollars to be able to get something the kids really want. So there's creative ways you can do that, and it's no less meaningful when it comes from you and somebody else than when it just comes from you alone. So, I mean, I think it's really open to having those conversations, and I don't care if you have a lot of money. It's the fact that you approach it with a purpose and a meaningful approach is the right way to go about giving and being generous anyways.
Yeah, I like this notion of the older person sharing their knowledge and wisdom with the younger generation. And they may not necessarily say that's the best gift of all, but it's a pretty good gift on the whole. You mentioned, Cary, credit cards, and I think there's a stat in the survey that says 79% of shoppers use credit cards, 52% don't pay off their balance. So curious about what ways retirees should be thinking about using credit without compromising their security, financial security, maybe their credit scores.
well, that is such a good question. All right, let's think about this for a second. 4 out of 5 people are using a credit card to acquire the gifts that they want to give away. And then half of those aren't paying them off. And even as you dig deeper into the poll, some of those take half a year to pay off the credit card. So, okay, if you have to use credit cards, maybe consider the ones that, one, obviously have the lowest interest rate or have some significant rewards to it. But really, trying to use what we talked about earlier, saving in advance to not have to use a credit card at all. So we really want to go now. Here's a new category of people who the only way that Christmas is happening this year is if it's on a credit card. So here are some practical steps then if you have to use it. The first thing is set your card to autopay, and autopay either an amount that is set into your budget so that it gets paid off quickly. The most ideal is autopay the full balance, but let's assume you can't afford that. And keep it simple by using one low interest card. You might have 5 available to you, but that makes it more difficult later on to go, okay, which one am I using for this purchase? Which one did I use for the holidays? And it'll help you when you're kind of doing the accounting in your head, to go, okay, I use this one card. I'm going to make sure to pay off this one card, and probably word to the wise, avoid those fantastic deferred interest promotions that you don't have to pay on for a while, but then suddenly come due 24 months later. That is just an easy way to step into the debt trap and have feel that steel trap wrap around your ankles when the money comes due.
Yeah. Gentlemen, we have to take a short break, and when we come back, we'll talk about some other findings from the survey. So don't go away. Welcome back to Decoding Retirement. I'm speaking with Dan Snyder and Cary Sinnett, both of whom are at the AICPA. We're talking about the Harris poll about holiday spending. And gentlemen, one of the findings in the survey is that 39% of shoppers feel regret about overspending. And I want to play a clip from you. Earlier this month, we interviewed Gene Chatsky about this very topic, and like to get your reaction.
Being unconscious is the overarching habit that gets people in trouble. Whether you're unconsciously spending because we just swipe and dip and click and tap and money moves so quickly, whether you are unconsciously not paying attention to your investments. You've got to get yourself to focus on what's coming in, what's going out, and where it's going. And if you know those three things, you're going to be in much better shape.
Sound advice, gentlemen?
I have been in that place where I make an unconscious purchase. I'm in a store, I see a great deal, and I want to get it right then. And I'm even thinking about the person that I really care about, how this will be so great for them. But one, it's probably not in my budget. Two, it's certainly not on my list. And so I've been a victim of that unconscious spending and it comes from a good place. But especially retirees can avoid this kind of emotional conflict that happens just by first stepping back before making that purchase. I know it's tempting when something great looks good right there, but focusing on their values rather than any guilt or, fear of missing out. One of the things that my aunt did, and I thought she was so smart for doing this, Bobbitt, she took her credit cards and this is kind of funny. She put them in the freezer and she put it in like a plastic cup full of water and put her credit card in there and put that in the freezer. And so she could get to it. It's right there in the freezer. But what did she have to do? Just a little extra step to use her credit card. And so if I think that's the first big thing, that if you're concerned about that unconscious spending or maybe overspending, is just add a extra layer. If you know exactly, if you're a conscious spender and you're like, okay, I'm making a list, I know who these things are for, look at your list so that you can add the emotional attachment to it in a very positive way. Write down who it's for, what it is, and then why you want to purchase that item. Connecting the why to your shopping list will make sure that emotionally you feel great about what you purchase. And it also helps you avoid that last minute pressure because you've made a list, you're checking it twice, and you're also adding the why for that person.
Yeah. Dan, there's another finding in the survey, throw it your way, which is that 25% of people cite rising everyday expenses as a barrier to holiday spending. So how can retirees sort of prioritize their essential needs while still, being able to afford some holiday gifts for their loved ones?
That's a hard question to, that's a one of those questions. It's a practical rubber meets the road type of questions. And, sometimes you get, kind of off the cuff answers on that. But, I think that part of what you have to do is you look at and see, understanding what your costs are. You'd be surprised at how many people don't really know what their real costs are. And you get this scope creep when it comes to your actual expenses. And so all of a sudden you find yourself in debt problems, perhaps because you want to spend money on Christmas or something like that, and you don't realize that your other expenses have maybe crept up to a point where maybe I need to be concerned about it. So one thing I would say is to go back and get a sense of what your expenses are. And then you hear the word budget, everybody gets all antsy. I like to call it a spending plan because it's a little less, in your face. And it really says, I want to spend it. I can spend it. It's my money. I earned it. I can do that. So give yourself permission, but do it on a scheduled approach there. So that is a starting point, knowing what your expenses are. Any additional thoughts on that, Cary? It kind of builds from there.
Yeah, you bring up such a good point that we really need to make sure that in advance of spending, you know how much you have to spend. And so either maintain a monthly cash flow worksheet or a spending plan, as Dan has pointed out. And there are some really good apps out there. You Need a Budget is an app that, I hate to say the budget word, but that's a good app to look at. Monarch is another one. And so if you're in a place, and many banks offer this online, just a look at your cash flow coming in and out and categorizing those. So take that first step to go, How much am I spending? Where am I spending it at? And how much do I want to spend on the holidays? But if you are considering buy now, pay later, that should be a red flag for you. If you are assuming future income is going to cover today's spending, that's a red flag. And so it's important that as you go into this season, that you're not spending money that could be hampered down the road. And I think our most recent government shutdown is a great example of that. People kept doing their jobs and didn't get paid. Had that shifted just a month or two later, it really would have hampered holiday season for all of those workers who had to dip into credit cards or savings in order to get by. So just be thinking anything can happen. Let's be kind of safe. Here's a couple of practical tips. If you're in that 23% that, is really going to be helpful for. One of the things that our family did, and this was so hard because it is so convenient, but really makes a difference. Just turn off one-click shopping. Just turn it off just for the holidays. So when they show you those fantastic boots while you're shopping for others, you don't go, "Yeah, I need a Christmas present too." It's if you want to get yourself a Christmas present, I think that's great. Just think about it in advance. Put yourself on that Christmas list along with the why. And yeah, maybe temporarily unlink. I know this is going to be hard to even think about credit cards from online accounts, meaning, you know how it automatically fills it in, or if you're on Amazon or some other shopping place, it makes it so convenient. Having just a little bit of friction between the idea of seeing something great and being able to have it on its way already will give you a moment to take a breath and go, does this fit into my cash flow? Have I looked at a budget? Do I know how much I'm spending in this particular area? Those really practical things to know about your own money will help you feel great 2, 3, 6 months down the road.
Yeah, if Jean Chatzky was here, she would say, you're being conscious of your spending. So one of the other survey highlights for me anyway was this notion of people using credit card points for travel. And I'm curious, are there some good ways for retirees to maximize the rewards and minimize spending during the holiday season if they have a lot of points?
Absolutely. So, Dan talked about this in giving people experiences. Take a look at using those points to do travel. And I know for me, that was one of the best early gifts that I received. And we did not travel far, but it was an exciting thing to have happen. And I think we need to remember, especially if we're giving gifts to the younger generation, they may not have experienced the same things that we have yet. This might be something completely new to them. And we have all these points from a card that, just kind of hang around there we might want to use.
Yeah, and
I think that
Yeah, I was going to say points are one of those things that I think it's easy to spend. The danger of points is that you start spending to actually get the points, and you have to remember the points are usually worth a penny or two on a dollar at the most. And so again, it's one of those traps that if you have a lot of points, great advice. If you don't have a lot of points, I'd be careful on that just to make sure that you're not spending purely to be able to do something. It's like taxes, and I'm spending because I'm going to get a tax deduction. I mean, it's just not good advice. So
yeah.
keep that in mind as you're thinking about points.
All right, gentlemen, we're going to take a short break. And when we come back, we're going to switch gears and we're going to talk about year-end tax and financial planning moves to make. So don't go away. Welcome back to Decoding Retirement. So with just a few weeks left in 2025, the American Institute of CPAs is advising taxpayers to take action and make year-end tax and financial planning moves that can help prepare you for 2026, especially at tax time. And I've been talking to, as you know, Dan Snyder and Cary Sinnett, both of whom are in the AICPA Personal Financial Planning Division. Dan, I want to talk about the tax landscape transformation with significant tax law changes coming in 2026. What are the most critical financial moves that retirees and near retirees need to make before December 31st?
This year's been a challenging year. We spent the first half of the year kind of thinking about all the stuff that was going to end, and sunset was the word that you heard top of mind. And then, the new tax law came into effect mid-year, and we spent the rest of the year trying to figure out what in the heck really happened and what it looks like. So now as we get down to the end of the year, a couple things really, really stand out here. Um, Particularly for folks that are on have in various income brackets. And that's probably the biggest message is this year is, I would say, know where you are from a bracket perspective, because that piece of knowledge, and this is like technical. This is not something you're going to figure out. That's why it's so important to if depending on where you are in the continuum there, to involve working with the CPA on the tax side of things. But the new tax bill is focused on the importance of really bunching income to the extent you can control it, and expenses to the extent you can control it, from one year to the next, with the standard deduction, the the itemized deductions are harder than ever, particularly when you think about retirees. They paid off their house. They maybe have moved from a high property tax state to a lower property tax state. So they just many times they struggle to itemize. So one approach there is to maybe bunch those together. You combine that with the concept of, as you get older, depending on where you are relative to your required minimum distribution RMD starting age, you're going to have perhaps a lower income time of period in your life or a higher income time period in your life. And so bunching and matching up that RMD and when that's going to happen with these expenses is another way that you can, if you're going to have a higher income, let's try to bunch those expenses, take advantage of, let's say, higher medical bills. If you've already spent a lot this year, is there things that you need to be doing that's going to push you over those floors and that type of thing? So that's probably the one of the biggest ones. I think other tools, other strategies that are commonplace that you hear a lot about are Roth conversions.
Yeah, actually, before you go there, Dan,
Oh,
let me just
yeah,
back up to the deduction for a second. When I think about the
sure.
itemized deductions, there are two things that stand out to me. One is the SALT deduction has been increased temporarily, at least to what, 40,000, I believe. And
Yes.
also that there's the senior deduction, and people need to think about all of that as they're contemplating whether to itemize or to use the standard deduction.
Yeah, there's a lot more tools at their fingertips to be able to do that. Seniors that are able to take, if they're taking the standard deduction, they're already at like a 23,000, almost 24,000 deduction threshold before they ever think about itemizing. So depending on, those tools can be things that can push you to the next higher tax bracket if you're not careful. So knowing where you are relative to that becomes really important. And certainly all of those things, understanding what is going to push you up and what are things that are going to allow you to pull back down again, I think are really important there.
Dan, you talked about bunching expenses. Can you also bunch charitable giving? And how would that work? What does that look like?
Well, charitable is probably the biggest thing, and I don't know if we're going to hit that later, but charitable is one of those things that there's a lot of tools that have opened up that I think it's an easy one to think about bunching, because you can use things like techniques like a donor advised fund, where that allows you to contribute money into an account and get the deduction right up front, but then turn around and you can spend it through that donor advised fund into the types of things that are most important for you. So that's one way that you can do that type of and have some level of control over it.
So you decide later when to spend it and where to spend it as far as where that charitable money eventually ends up?
Yes, you have that control. You control that, but you don't. It's not in your name. It's in the donor advised fund's name. So it's out of your tax situation, but you got the tax advantage right up front. But then you can control that over a period of time.
Yeah. The other aspect of charitable giving, I think, gentlemen, that comes into play would be a QCD, or a qualified charitable distribution, which would also help you to sort of maximize your charitable giving and maybe help your income too, right?
Sure. And I think that the key there is to remember that the QCDs kick in at 70 and a half, the ability to do that, versus many times the RMDs for people that are newer, 73 or even older would be 75. So recognizing that you can start doing QCDs even if your RMDs are not, sorry, so many acronyms here, but you can start doing that sooner so that you can start moving that money out. It has the advantage of reducing your qualified, your IRA money, your pre-tax money, to reduce the potential of the size of required minimum distributions later, but it also then reduces your AGI, and it doesn't even hit your taxable situation. So I think the benefit there is before your RMD, it helps for the future. After your RMD, it's even better. But again, you have to start with a charitable intent. If that's not your intent, if you need it to live on, let's get our priorities right there and make sure that we're addressing the needs we have there in front of us as well.
Yeah. Dan, you started to mention Roth IRA conversions, which is among my favorite topics for near retirees and pre-retirees and retirees. And I'm curious, a lot of folks need to determine if it makes financial sense to them. Walk us through the process that you would use.
Well, the simple math is this year's tax bracket going to be a lower tax bracket than what you might pay in the future, and do a Roth conversion to be able to pay it at the lower rate. So that's the simple math. The other piece of the math you look at is the tax brackets. There's no sense in paying it if you're going to move from one bracket to another bracket, and you're at just a little bit over. So being aware of where you are on that continuum. I think the other thing that sometimes, and Cary, I'm interested to hear your perspective on this too, because there's a difference of opinion. I think sometimes it's easy to think about the tax consequences of Roth conversions, but sometimes we think about the fact that for retirees, this idea of cash flow and income available to spend is a totally different conversation than taxable income in my income situation. So sometimes we make decisions that are income related, taxable income related, but then we end up in a situation where we don't have the cash flow, or we're in that type of a situation there. So I think, sometimes Roth conversions are, you just take the distribution, pay the taxes on it, but perhaps it's better to have it in a capital gains, after tax account that's got capital gains. Yes, you have to pay capital gains on it, but in the future, but it gives you something that then you can use other tax strategies on for going against losses and things in the future. So there's other ways that you can do it. I believe in having, three buckets to choose from as you get into retirement: the after-tax money, the pre-tax money, and the Roth type of HSA Roth type of pre-tax money. And so when you balance those together, don't just blindly follow one approach. And I think Roth conversions gets a lot of publicity, and rightly so. But that's just some
Yeah.
thoughts to think about from that.
Dan, when you talk
Yeah, and
about
that's such
sort of income tax bracket management, a lot of times when I talk to CPAs and other financial professionals, they talk about converting enough to bring you up to the top of the 22 or to the top of the 24% bracket. Is that sort of like commonly accepted wisdom from your perspective?
Well, generally it is if you have the ability to pay the tax out of other funds. I mean, it does reduce it. And again, it goes back to basic math. If you reduce the amount that you're rolling over, you're going to have less there. Now, depending on how long your timetable is, it's going to be beneficial. But certainly, maxing out your bracket is certainly accepted wisdom, and I think an appropriate approach there. The other thing, that there's a whole lot of other things that come into play with respect to the tax brackets that we'll get into, I'm sure, but you know, not going over or purposefully staying under a bracket is probably more important this year than it's ever been.
All right, gentlemen, we're going to going to take a quick break here. And when we come back, we're going to talk about more things of interest to retirees as it pertains to tax planning. So don't go away. Welcome back to Decoding Retirement. We're talking about financial and planning tax moves you need to make before the year ends. My guests, Dan Snyder and Cary Sinnett, both from the AICPA. Gentlemen, I want to turn my attention to a topic of great interest to seniors, those 65 and older, which is the senior deduction, the $6,000 deduction that seniors will now get in lieu, I guess, of not having the Social Security benefit taxed. Tell us what seniors need to know about that $6,000 break.
Well, that certainly was the way it was sold initially, was this idea that I'm not gonna get my Social Security tax, but that kind of a backdoor approach. But basically, the way the $6,000 senior deduction works is that it is a deduction that's applied. Doesn't matter whether you standardize the standardized deduction or the itemized; it's layered on top of that, so it's a tremendously valuable benefit. And it starts at 150, or I mean, it maxes out at 100 up to $150,000, and then it starts to phase out up to $250,000 of AGI or modified AGI. So I think it's one of those tools that it really can make a huge difference on a couple, like a married filing jointly, because if they're over 65, they're each getting the 6,000. That's another 12,000 right off the top. So I think that, again, it's another tool that can be used that's going to depress or bring down the AGI, which then frees up other strategies that are you can take advantage of the fact that you've reduced your AGI by that amount. So it just engineering your AGI is really the name of the game when it comes to this year as we go into next year's tax periods.
There's just one thing that hope the listeners become aware of with what you just said. Social Security is not tax-free. And so each person's deduction is going to be unique to them. And this is where you really want to connect with your CPA, your financial planner, to look at how much of my Social Security is, how much of it is going to be taxed and how much is not. It's fantastic to have more available in the standard deduction for retirees, but we should really try to step out of this idea that all Social Security is tax-free. That's an easy myth to get wrapped up in.
Yeah.
Well,
And
yeah.
it should also be noted too, I think, that the senior deduction is not permanent, right? It expires, I believe, in what, 2028 or so?
2028. 2028. It goes from 2025 through 2028. So it is a temporary deduction and really benefits a group of seniors right here that can, and it's a huge benefit. I mean, it's money in your pocket that wasn't there before. So a real benefit of the current tax bill for sure.
Yeah. I want to turn my attention to RMDs, required minimum distributions, and we know there's a lot of confusion around them. Do I take my RMD at 73 or 71 or 72 or 72 and a half or whatever the year might be? And there's a penalty associated for not taking an RMD. Tell us what retirees need to know about the RMD and why it's so important that they know when to take it.
Well, I think, from an RMD standpoint, certainly there's a penalty, 25%. If you are timely about putting it in, they'll reduce it down to 10%, and many times it might even be waived entirely. But the types of things you need to be really aware of when it comes to the required minimum distributions, a couple of traps that are really good to point out. One is the idea of aggregation. Sometimes you hear that you can, do I have to take about each separate account, or I'll just take them all out of one account, and you can aggregate, but without getting too technical, the idea is that the accounts have to be similarly titled. So if I have a Roth IRA, if I have an IRA and I have a 401k plan, I can't aggregate, and that I have to do required minimum distributions from because I'm over the age. I can't aggregate those together. But if I have two IRA accounts, I can calculate them individually and then take it out of the one that I want to take it out of. So it gives you a little bit of flexibility if you're looking to maintain a certain mix between equities and fixed income, or that, which account you want to take it out of. and that type of thing. So that's one thing is the account aggregation. Just be very aware. And if you add in inherited IRAs and then inherited IRAs from your mother or your father, or your wife has inherited IRAs from your mother or your father. So for those baby boomers, it can get really complicated. So be very careful on the aggregation. The first year RMD that comes into play can be taken out as late as April 1st of the year after they turn 73. So if they do that, the trap is if they do that, they also have to take out the minimum distribution by December 31st for that year. So you really want to consider in that first year, do I take it out in the year I turn 73 or by April 1 of the year after I turn 73, knowing that potential trap there.
Yeah, and for that person who then turns 74 and 75 and whatever thereafter, they need to take the RMD by December 31st of each and every
Yes.
following year.
Yes, ongoing, it's always December 31st, and you'd want to make sure you do that. And that's how you avoid the penalties. And we want to make sure that we are able to contribute on a regular basis.
Yeah, so we spent most of our time here talking about what people should do at the end of the year, which seems a bit reactive. There isn't a lot of time to plan. Let's talk about things that people can do to be proactive as they enter January and allows them to sort of maybe plan more prudently when they have 12 months in front of them.
Yeah, so I think you can look at things from a budgeting cash flow standpoint. So some of the things we talked about earlier in our conversation here on savings and setting money aside, I think that's an important thing. I think when it comes to the as you plan for the next year, we talked about required minimum distributions. Is do I take them out early in the year? Do I take them out later in the year? Do I take them out gradually throughout the year? So there's different opinions on if the stock market is doing great. Do you want to let them ride? Because it's not going to change the amount of your RMD. It's just going to change how many shares you liquidate, so to speak. So that is one thing, to consider. I think another thing to consider is if you are nearing retirement and you're not actually retired and you're still working, the decisions around your qualified plans become really important. And I think the ability to maximize those contributions, if that's a goal, is to actually put those in place, and that you're maximizing your your deferrals, your pre-tax, and your Roth deferrals that you can do in your qualified plans. Then you, in addition, if you're over the age of 50, you have the ability to do a catch-up contribution. So that's going to push you over $30,000 of if you're trying to max that out. And then I'd be remiss if I didn't mention and you hear about this a lot, is what's called the mega backdoor Roth conversion. And then it's a lot of words, but the concept is if I'm maxing out everything else in my qualified plans and I still have discretionary income, perhaps I have two family members that are earning income and my family's got discretionary income, the ability to make non-deductible contributions into my 401k and have it immediately converted in the plan into a Roth conversion bucket inside the plan. And you can contribute up to a combination of your money in the pre-tax and Roth, plus the company's money, the company match, plus this extra Roth conversion that you can put in. It can be approaching $70,000. So there's a deep well there for people to take a look at if you have the means to be able to do that. So kind of thinking of some of those steps from a paycheck standpoint, HSA is another one. Knowing if you're in a high deductible health insurance plan, being able to maximize or set aside money for your HSA. In fact, we were talking about budgeting earlier and spending guidelines. I would recommend that you think about setting aside your money in the HSA, but also then if you have the capability to budget some money for medical in an after-tax approach, allowing you then to let the HSA, which is in essence income tax-free and tax growth-free, and if you spend it on let's say older retiree medical expenses, it's tax-free at the distribution. So 3 tax breaks So if you cannot spend it and just spend that out of your after tax, then I think that's another little thing you should be thinking about, and as a way to kind of get ahead for the next year, because that's what we're all about here.
And if I could just add in, since you asked, what could we be doing next year? It's really being mindful, since Dan talked about maximizing your retirement accounts. Brilliant. But a second thing you could do is really take a look at your investment losses and gains, and then have a discussion with both your investment advisor and your CPA to go, when would be a good time to either take gains if I have other losses I need to offset, or take losses to offset gains, or even capture up to 3,000 so that it rolls over into the additional year. It's a use it or lose it on the investment losses, so you might as well make sure that you at least take that amount each year.
Yeah, brilliant advice. Gentlemen, I'm afraid we've run out of time, so I want to thank you both for sharing your knowledge and wisdom with us and our viewers. Greatly appreciated. Thank you.
You bet.
Thank you. Glad to be here.
So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget, you can listen to and subscribe to Decoding Retirement on all your favorite podcast platforms.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.